Hello dear friends, my name is John A.G. Today is Sunday the 8th of February, and I want you to brace yourself because something is shifting in the markets that most people won't even notice until it has already priced them out. Right now a lot of people are distracted by the loud stuff. Stocks making new highs, flashy AI stories, crypto candles, political drama, but underneath all that noise a few quiet relationships are starting to tilt, and when those relationships tilt, history has a habit of repeating itself in the most uncomfortable way. And yes, I'm going to say it clearly, if this cycle plays out the way the long-term ratios suggest it can, silver doesn't just go up a bit. Silver can move into a different universe, triple digits, and a number like 350 stops sounding like a meme and starts sounding like a consequence. Now before we go any further, I'm running a cleanup campaign on this platform. You've probably seen the copycats. If you want to support the original work, hit subscribe right now and drop a quick comment. Literally our John A.G., so the algorithm understands you value this content. Alright, here's the deal. What I'm about to explain is not based on stories. You know the kind. Somebody sits you down, tells you the world is ending, explains debt, explains politics, explains the central bank, and by the time they're finished you feel like you understand everything, and then the market does the opposite. I learned that lesson the hard way, and I want you to learn it the cheap way, by watching patterns, not by paying tuition and losses. I started taking markets seriously right around the time of the 2008 crash, and like a lot of people, I was listening to brilliant-sounding arguments. Fiat currencies are fragile, the system is overloaded, the Federal Reserve will eventually print its way out. The global economy is a house of cards. It all sounded logical, it all sounded inevitable, so I went heavy into the precious metals trade, gold and the miners, because I thought if the world is wobbling, surely the safe stuff goes up. But here's what nobody tells beginners. In a real panic, almost everything gets sold, liquidity becomes king. Even safe assets can get punched in the face before they go on to outperform. In that period, gold dropped hard, stocks dropped hard, silver dropped even harder, and the miners were brutal. Big names got crushed, and the smaller exploration names got absolutely demolished. I remember watching those screens and thinking, how can I be right about the problems and still feel wrong in my account? That feeling is what changes you. That single experience rewired how I think, because it taught me something uncomfortable. You can be right about the diagnosis and still be wrong about the timeline, the path, and the outcome. So I stopped marrying narratives, and I started marrying price, not the day-to-day noise, not the emotional candles. I mean the big, slow, structural relationships, ratios that take decades to build and then break like a dam when they finally move. And the most important one for this entire conversation is the relationship between mainstream stocks and gold. Now imagine I've got a chart in front of me. It stretches back well over a century, the kind of chart that makes people yawn, but it's the exact kind of chart that decides who retires early and who works another decade. On that chart we're looking at a simple concept. The Dow Jones versus gold. When the line is high, stocks are winning. When the line is low, gold is winning. That's it. Simple. Almost childish. But what it reveals is not childish at all, because over that long history, the line doesn't move randomly. It moves in huge, multi-decade waves. It climbs for years, then rolls over, then collapses, then rebuilds, and those collapses are where the transfer of wealth language comes from. Let me explain it in plain terms. If the ratio is rising, it means 1 ounce of gold buys fewer units of the stock index over time. Stocks are gaining purchasing power faster than gold. People feel smart owning stocks. People feel silly holding metal. That's the mood. If the ratio is falling, the reverse happens. Gold buys more and more of the stock index. Your metal is purchasing more of the mainstream market, and that's a totally different world. That's where the headlines get dark and the crowd starts asking, why didn't I see this earlier? Now here is where my cursor would be on the chart. I point to the massive peaks, moments where the ratio got too stretched in favor of stocks. Those peaks are not frequent, they're rare. They're the moments when the public is most confident and most leveraged into the new era story. Then I'd slide the cursor down to the valleys, moments where gold completely dominates. Not because gold is magical, but because trust in paper systems and overvalued assets is being repriced. And when you look at those big waves, you can break them into what I'll call turnings. Not every little cycle, the big ones, the ones that change how families build wealth. First turning, the roaring boom era, new technologies. Big optimism, speculative fever. People thought the future had arrived and nothing could stop it. Then the crash came and the stock side of the equation got destroyed relative to gold, not by a little, by a staggering amount. Back then gold had a different monetary role. The mechanics were different, but the psychological effect was the same. The mainstream portfolio broke and the boring asset became the reference point. Second turning, the late 1960s into the 1970s, another era where leadership flipped. You had a mix of war spending, social strain, and a monetary system that changed shape. Gold, which had been ignored, suddenly mattered again, and the stock market, when measured against gold, lost a shocking chunk of purchasing power. This is where people usually underestimate what measured in gold really means. It doesn't mean stocks go to zero. It means the currency and the pricing regime changed so much that gold, as a store of value, wins the measuring contest. Third turning, the early 2000s after the tech bubble. Another extreme, another reversal. The market had priced perfection, then reality arrived. And for years after that peak, gold did the heavy lifting while the mainstream market struggled to keep up in real terms. Now I want you to notice something. Each turning had its own story on the surface. New technology, war and inflation, the internet boom. But beneath the surface, the ratio did the same thing. It went from stretched to breaking to collapsing. Which brings us to the question that should make your stomach tighten. What if we're entering the fourth turning right now? I'm not asking that as clickbait. I'm asking it because the ratio line, the one that normally drifts slowly, has been showing signs that the long upward trend in favor of stocks is cracking. And if you've never watched a long-term trend break in real time, let me tell you, it doesn't feel dramatic at first. It feels like meh, it feels like maybe, it feels like it'll go back, until it doesn't. Now people argue about which stock index you should use. Some prefer the S&P, some use broader baskets. But the Dow has a very long record. And across long periods, the major US indices tend to move together. The point isn't to win a technical argument. The point is to see the cycle, and the cycle historically does something scary when it flips. If you take those previous three major turnings and you look at what happened to the Dow measured in gold, the average outcome is violent, not a gentle drift. A compression that can feel like a collapse. Now I'm going to be careful with words here because people mishear this. This isn't a prophecy that stocks will die. This is a framework that says in certain eras, gold outperforms stocks so dramatically that the ratio can fall by something like 90% from peak to trough. Again, from peak to trough measured in gold. It's a purchasing power shift. I can already hear the objection. John, that's only a few data points. Fair, it is only a few, but it's also all the major regime shifts we have in a modern gold-priced stock market history, and the key isn't to worship the exact number. The key is to respect the direction of the break and to understand what it could imply. So let's talk numbers in a way that makes it real. Right now, just using round figures to keep it simple. Imagine the Dow is around $50,000 and gold is around $5,000. That's a ratio near 10 ounces of gold to buy the Dow. Now imagine that ratio compresses to around 2.2. Even if you ignore history, just the math is enough to sober you up. Going from 10 to 2.2 is not a small move. It's a massive repricing of what a unit of gold can purchase in the mainstream market. And the next question is, how do we get there? Here's the uncomfortable answer. There are several paths, and more than one path can hurt. Scenario 1, the deflationary gut punch. In this world, the stock market gets hit hard, maybe down dramatically, and gold might even dip at first because of forced selling. That sounds weird until you remember what happens in crises. Margin calls don't care about your thesis. People sell what they can, not what they want. This is the scenario that scares both tribes because it punishes risk assets and it tests patience in metals. It's the kind of move that makes people quit right before the reversal. Scenario 2. The stagflation grind. Stocks sag, inflation sticks, confidence decays, and gold rises because people need a store of value that isn't a promise. It's not a single crash, it's a long erosion, and erosion is psychologically harder than a clean shock because it exhausts you. Scenario 3. The inflationary blow-off. Stocks might stay elevated nominally, but gold rises far more because the unit of measurement, the currency, loses purchasing power. People look at stock prices and think, I'm rich, and then they go to buy real stuff and realize they are not. Different roads, same destination, gold outperforming the mainstream stock basket. Now, if that ratio target is the compass, let's do simple math for one of those paths. And if you think that sounds insane, here's the twist. A number can sound insane only because you are measuring it with your current mental frame. When regimes change, the old frame becomes useless. If the Dow doesn't fall much at all, but the ratio still compresses, then gold has to do even more of the work. That's how you get to those eye-watering projections. 20,000, 30,000 numbers that sound like science fiction in the current currency regime. But remember, we're not worshipping the exact price, we're mapping what the ratio implies. Now I'm going to pause right here and ask you a question, because I want you to play along. Which path do you think the world chooses first? Deflationary shock or inflationary spiral? Comment deflation or inflation below. I read those comments and it also helps this video reach more people. Alright, gold is the anchor. But the reason you clicked, the reason the title hit you, is silver. So now we zoom out again and we look at the relationship between gold and silver. The gold to silver ratio is simply how many ounces of silver it takes to buy 1 ounce of gold. When that number is high, silver is cheap relative to gold. When it's low, silver is expensive relative to gold, and this ratio has moods. In fear, it can spike because silver behaves more like an industrial metal and gets treated like the riskier sibling. In inflation heat, it can compress because silver behaves like a leveraged version of gold and the crowd rushes into it late. Now I want you to picture another chart. This one looks like a heartbeat over decades. Peaks, crashes, rebounds, and you can roughly divide it into zones. There's a panic zone where the ratio runs very high. That's typically when people want maximum safety and they choose gold over everything else. There's an inflation hype zone where the ratio runs very low. That is typically when silver is catching fire and the public starts talking about it like it is a lottery ticket. And there's a middle zone where the economy can be weak, but prices can still rise. What many people call stagflation. That zone is where silver can do very interesting things because it has both monetary demand and industrial demand pulling at the same time. Now, one target that gets discussed in this framework is a move toward the high 30 seconds, around 38. Now, let me add one more layer that most people miss because it sounds boring until it becomes explosive. For a long stretch, the Dow versus gold relationship basically moved sideways, not day to day, over years. It was like the market couldn't pick a winner. Stocks rallied, then gold rallied. Stocks rallied again, gold held its ground. The scoreboard kept returning to draw. When you see that kind of long stalemate on a century-scale chart, it's unusual. It means two belief systems are fighting. One side betting on growth and innovation, the other side betting on debt pressure and currency decay. And here's what happens after long stalemates in markets. The next move is rarely gentle. The longer the spring compresses, the harder it releases. This is also where the word stagflation starts showing up and people roll their eyes. Some economists act like stagflation is a myth, because in theory inflation should cool when growth cools. But in the real world, stagflation is simply weak growth mixed with stubborn price pressures. It's messy and it's political and it's exactly why precious metals can shine. Because when growth is weak, politicians get pressured to do something. When prices rise, voters get angry, and in that squeeze, the usual response is not austerity. The usual response is more spending, more programs, more promises, and eventually more money creation to keep the machine running. That's not a moral judgment. It's an incentive problem. Cutting budgets is unpopular. Raising taxes is unpopular. Printing and borrowing feels painless until it isn't. So when you hear a metal thesis built around they'll print, don't treat it like a conspiracy bedtime story. Treat it like a basic observation about incentives, and then watch what the ratios do.